Today, we're joined by Mike McGlone, Senior Commodities Strategist at Bloomberg Intelligence. We're going to talk with him about his outlooks on the economy, the future for interest rates and inflation, as well as where investors can position themselves. Mike, welcome to the program. It's good to have you here.
Well, thank you, Patrick. It's good to be on. It's my pleasure to get to know you.
And likewise, I just wanted to mention, or just tell you and most of the audience, or remind the audience, a lot of those watching are either active military or veterans. And so while we're going to focus kind of on economic issues, I do want to give some guidance to maybe some of them on ways that are unique for them to take advantage of trends that we see in the future.
Well, that's my primary focus. And one thing I want to do is thank you for having me on as a son of a U.S. Marine, father of a U.S. Marine. My eldest son is a captain in the Army. I've always been a military wannabe. I want to do everything I can to help out our veterans. And thank you for your service.
Well, thanks for saying that, Mike. And thank you for your family service. I wanted to kind of start out by talking a little bit about your future forecast, or where you see the U.S. and global economies going over the next 2 to 3 years. Like, where do you see those economies going? And from a macro perspective, how do you see that impacting the investing landscape?
I think we're due for a normal reversion of the strong economic growth we've had for like the last 20 years, certainly a reversion of the massive pump in liquidity and some deflation reciprocal to the inflation. And that might sound all bad somewhat, but I think there's opportunities here for some more tactically orientated people to be a little bit more defensive and focus on less risky assets. And the key thing I want to point out from a macro standpoint, I see the U.S. crushing it in the world global stage. Our system is just unstoppable. Checks and balances, we say it's people say we're divided. No, it's just a classic checks and balances. And what I see in the macro is China heading for a pretty normal reversion of a rapidly growing emerging market that's going to be more like a U.S. depression in the 1930s. It's all tilting that way. All my signals are going that way. And I don't see what stops it at the moment. So from a macro standpoint, I'm a commodities strategist. I see commodities are showing severe deflationary forces. Gold is the only major commodity up on the air. It's actually beating the S&P 500. This year, it's up 18%. S&P 500 total return 17%. On a one-year basis, gold is up 23%, and S&P 500 is up 20%. I think that's going to endure, so I'm still biased towards gold. And I think we're going to see some normal reversion in underperformance in beta, meaning the stock market. It's way overdue. And I show a lot of indications for that. But I'll end with this. The key indications I have from commodities are gold up, energy down, industrial metals. Bloomberg Industrial Metals was up 24% in the year. Now it's basically unchanged. Pretty severe deflationary forces, but it's really normal for that to happen in commodities. When they go up too much, they always go back down. They have to find a cost of production balance to start recovering. But what's happening, what's really changed in this world in just 20 years is the U.S. is now the largest producer of energy, one of the largest exporters in terms of liquefied natural gas and energy. People are worried about the release of the SPR. Well, the SPR, which is the Strategic Petroleum Reserve, was set up when U.S. was importing a lot of barrels. It was set up to cover 90 days of imports. And now we export a lot. And we're also a massive exporter of grains and agriculture. And the problem is they're having an increasing abundance of supply over demand. And we have to export that to offset that. And we have a strong dollar, which makes it harder to export it. So that's a deflationary force I think is going to continue. And then one thing that's also happening, you've seen out of China, like I mentioned, it's got a property crisis. It's just a normal reversion of rapidly growing emerging market. And they're exporting massive amounts of deflationary forces that provide energy, that create energy, that reduce the use of petroleum, renewables, EVs, and things like that. So from a macro standpoint, I look at the U.S. stock market as very extended, very rich, and there's alternatives. For instance, the U.S. government T-bills at 5%, and treasuries are still, most of them are still yielding high 4s or 5%. It's a nice alternative. We haven't had that in almost 20 years.
Mike, do you see, you mentioned deflationary forces, both at home and abroad. Do you see that as forcing the Fed to do a very difficult or very hard pivot to cutting aggressively, and then creating the fixed income area of investing as being a little less attractive in the future?
Not
Or
yet.
do you think something different? Go ahead.
Yeah, not yet. I'm glad you went there because I want to explain. Most people will say, well, what do you mean inflation? Everything, deflation, everything's I'm trying to buy is much more expensive than it was 4 or 5 years ago. That's how it usually works. Is deflation is the result of when that base of prices goes too high, say an average price of a home goes to $400,000, $500,000, and then drops. And that's what we're going to be doing. That's my job, to predict the future, not to measure the past. So I want to point that out right away. I have to point out that's a normal trajectory in inflation, prices going up too high, and then deflation when they go back down. The thing that's different this time is typically the Federal Reserve will cut rates on the escalator. And then they raise rates really rapidly. I'm sorry, they raise rates on the escalator, going up slowly, and then they cut them rapidly on the elevator. This time it's been opposite. We've raised rates so fast because basically we've learned the lessons of way too much liquidity. The government, our government, threw way too much money, way too much liquidity, fiscal monetary money at the system starting 4 years ago. Rightly so. A lot of us, because of the pandemic, thought we could die. Now, that hasn't happened, but it did what's normal. When you throw way too much money at something, all the physical prices, things you buy with that money, goes up. But now we're taking that away. And all the lessons of history are that we should continue this reversion process. Now, the key bottom line is it hasn't started in most other things except commodities. I like to point out the price of natural gas this year dropped to the first price that was first traded in 1990 in futures. Now, natural gas is the number one measure for heat, electricity, and fertilizer in this country. The number one. It hasn't been in the past, but it is now. Crude oil. Crude oil, the price of 78 right now is the same as it was first traded in 2007. We have a massive overabundance of energy. Why? Because we've harnessed that technology, and we have a population that's using less and creating more. But so to me, that's the process that's going to happen. And there's one key thing that's been keeping everything elevated, and that's the U.S. stock market. On a market capitalization basis, the stock market is, in some measures, the most expensive on the way up since 1929. It's basically right now at about $57 trillion total market cap. U.S. stock market's 2 times GDP. To put that in context, when it peaked in 2000, it was about 1.3 times GDP. So we're just up too much, and we're overdue for a reversion. Maybe it's different this time. Maybe we won't go back to that. This is a Warren Buffett model of 1 to 1 or a little bit less than GDP. Maybe we'll stay elevated for a long time, but typically takes a trigger. And that's what I look for alternatives. So that's why I've been pointing out maybe a little bit underweight in equities and overweight in things like gold and treasury bonds. Now, treasuries have yielded a lot. They haven't done well, but when we start this process of the Fed easing and potentially if risk assets go down, that's to me when things are going to change. And that's my outlook. That's my job to point out outlook. And I like to think about things that are going to be changed and reverse that. And the key thing I'm worried about is just how expensive U.S. stocks are. Maybe it stays that way for a long time. And what you mentioned about the Fed. So I think what's different this time is I'll end with this. It's Jeff Booth wrote a great book called The Price of Tomorrow, all about how technology is just creating so much deflation. And he pointed out humans are about successive corrections of our own errors. And one error we made in the last 5 years is creating too much liquidity and inflation that became from that. So every single time there's going to be pressure for the Fed to ease, unlike in the past when it said, oh, you got to save the stock market and you have to save things, there'll be pressure like, well, if you ease too much, you're going to create that inflation that crushed us all last time you eased too much. So to me, that's what's changed, and we have to look forward to that in the next few years.
Mike, I was going to ask you, you'd mentioned the risk associated with the safer investments like fixed income, particularly treasuries, and that being potentially an area where investors may want to be a little bit more overweighted in the future, at least. Is there a part of that curve, if you will, the short end or the long end, that you think would be an area you'd want to be a little bit more positioned in, if you're looking for something that's safer?
Well, the
What in your
safest are U.S.
view would that be?
Yeah, the safest are shorter-term U.S. Treasuries, 2-year notes on in T-bills. The riskiest are long bonds. Treasury long bonds right now yield 4.36%. To put that in context, in China, let's just use a 10-year note. The U.S. 10-year note is 4.1%. In China, it's 2.15%. In the past history of we have about 20 years of history, China's 10-year note yields are almost higher than U.S. Now they're lower. Why? Because they're heading towards recession. So the biggest risk is that rates go up and there's more inflation. If you buy longer-term treasuries. In short-term treasuries, the safest assets on the planet. People can dispute that, but they basically still are. So my bias is that it's somewhat. I like all treasuries, and I think if you're willing to think that we're going to be more of a recession type deflationary recession, which I am, then long treasuries have some attraction. I've been early. I've been wrong for 2 years, but it's just starting to tilt that way. I just use the rest of the world example. When people say issues like, oh, we have too much debt in this country, well, so does many other countries, and their rates are much lower, and they're nowhere near as safe as the U.S. So one example is Japan. Their debt to GDP is almost 3 times. In this country, it's maybe 1.3, and the 10-year yield in Japan is about 1%. And for the last 20 years, it's been much less than that. So I think there's certain times you're supposed to look to be safe, and people on the sell side of the business hate when I say that. That's where I love being in Bloomberg Intelligence. I'm neutral. I have no positions. I'm not really allowed to trade a lot. I just point out things the way markets are going. And that's why I'm still bullish gold. I've been pointing out I think gold's going to continue to go up. Remember, we do have a Cold War going on. It's heating up. And I think part of that bullishness of gold will be connected with Treasury yields going down, which means bonds will outperform shorter end. But the key risk I'm worried about is at some point we get a normal backup in the stock market. So I'll end with this. What I'm worried about is right now, on the year, the S&P 500 is up 17%. That's the total return. It was up 23% for a while. If we end up the year up 8 to 9%, that's still a good year. It's a normal year. But think of how that would trigger the feelings for the rest of the year. So that's the key thing I want to talk about is momentum. In this commodity market, we have very bad downward momentum. They peaked in 2021. They bottomed. They went up a little bit this year. Bloomberg Commodity Index was up 12%. Now it's almost down. Industrial metals are up 20%. Now they're back down. Everything's starting, from my standpoint, starting to tilt back downward. And that's usually a sign of deflation.
You mentioned gold is an area you're bullish, but most commodities you see as having this downward momentum. Are there any other commodities aside from precious metals that you see as having some potential right now that, in the medium to long term, I guess we could say more the medium term, might even be a good play now? Or is your optimism really confined solely to the gold/precious metals market?
Yes, it's not that complicated. In an environment that I'm fearful that we're going to be heading towards, gold has a history of outperforming versus all commodities over time. I just reread a little bit of Adam Smith's The Wealth of Nations from 1776. He mentions gold, silver, copper, corn. Didn't mention crude oil because it didn't exist then. And it's been faded away. It's just the enduring safety of the precious metals. Now, I also like to point out, I've been saying for a few years, it's the world going digital rapidly. It's somewhat risky to hold gold without some Bitcoin in that space, but Bitcoin's a highly risk asset. And I think if I'm right about some normal reversion in beta going down, then Bitcoin have a problem. But I still stick with, I think gold's going to continue outperforming virtually all commodities. And the key difference is storage. I mean, you can store gold on your finger, you can buy ETFs and things, and it's really don't have to worry about cost of storage and things. But almost all other commodities, you're better off typically buying the producers of those commodities, which oftentimes means equities. And so that's another nuance.
Do you see the equities as having greater risk than the gold itself? Or would you advise against that? Like if somebody was more risk averse, would you see as the gold, just the metal play, as being the better play?
Well, it has been. The key thing I'm worried about is gold miners have been way underperforming the metal. know exactly why that's happening, because typically what I'm concerned about is the fact that with stock market going up, the broad market that much, and those gold equities underperforming, gold going up, that's not a good sign. But it's different. It's a different ball game. You get earnings in the equities. Typically, you get more of an optionality, and depending if it's a broad equity or indices. But I usually like to be diversified, and that's what I see most people doing, buying both.
And Mike, as you know, and I mentioned earlier, a lot of our viewers are active military or veterans, and they have, or we have, you may already know this, having so many family in the military, they have what's known as the thrift savings plan, right, which is their retirement program. But in that program, there isn't really a commodities or precious metals investing fund. Again, not making any recommendations on funds to invest in. What are some examples of gold funds that would help someone who can't put that in their 401k or in their TSP? What's an example of a fund that would, give you that exposure? Again, not making recommendations that people buy these, but just using them as examples.
The top traded gold ETF is GLD. There's numerous other ones. You just Google gold ETFs. There's precious metals ETF. One is called Glitter GLTR, which holds gold, silver, platinum, and palladium. There's a lot of those. But there's also things you can do. Is the key thing I like to warn people is, particularly if you're of age, like my father's a Marine Corps veteran, and I have taken over his. He's almost 90. His investments, and his investment advisor had him way overweight equities. I mean, like I went zero in equities at that age, particularly when you get 5% guaranteed in US T-bills. So what people can do is just be careful. Follow the lessons of Benjamin Disraeli in this case. He's a former UK Prime Minister, pointed out what we generally anticipate does not occur. And right now we are, there's certain times, certainly for people who've done very well in equities, everybody always says in it for the long haul. The lessons I learned in 2000 and up to 2008 is everybody's in it for the long haul as long as it's going up. And that's why we have to just be very careful. At some point, it's probably prudent to be less overweight and more underweight risk assets and more overweight risk off assets. And treasuries are the key thing that are sticking out here to me. But that's, I just, people can make their own decisions, but I have to point out what I think things are going is we're due for a normal reversion in the US equity market. And I'll point out the fact is at 2 times GDP, it's the history of the market capitalization stock market. It always goes back to 1-to-1 to GDP. Maybe it's different this time, but we're like the most expensive on the way up since almost 1929. And that's just, these things can last a long time. But when they unwind, you want to make sure you don't get hurt. And that's why I want to be careful. But everybody here, some of their advisors, oh, in it for the long haul, in it for the long haul. Everybody is. I remember they all were. And then I saw a lot of the pain in my history when things just normalized. And I'll use, there's so many facts I can point out, but one of them is, here's one key measure that kept me, I was more of a trader in the past, but in 2007, one of my major signals was volatility on the US stock market, the VIX volatility index. That's a measure of, some of our listeners will know about it, of US stock market. The 52-week moving average of that, minus the T-bill rate, dropped to the lowest in its history. This was 2007. And then we had the great financial crisis. Right now, we're at the lowest since 2007 in volatility. And a little lesson I like to point out, I learned in the trading pits in Chicago, is volatility is always mean reverting. So volatility is so low, treasuries are so high, that's the stock market volatility, that I think the more prudent investors are underweighting risk assets and overweighting risk off assets. And that's one key indicator. Volatility will always mean revert. And at some point it'll go up. And at some point rates will go down. And just be careful with that mantra that always in it for the long haul, because everybody is until it goes down.
Right. It's a really good point you bring up, because it's usually where they'll really need a financial advisor to keep them in it for the long haul. Because if they don't have that, it's very easy to get fearful and bail out. You made a couple points, Mike, that I thought were really good, really interesting, and I wanted to follow up on them. You did that GDP to, stock market comparison. Also, what do you think of the Dow or S&P gold ratio? Because you'd mentioned our stock, our equities are overvalued right now. Does the stock to gold ratio tell us that same story in your
Yeah.
opinion?
I'm glad you.
Okay, and what is
I'm,
your view on that?
I'm glad you went there, Patrick. Yeah, the S&P to gold ratio. I use the S&P 500 because if you just take the S&P 500 divided by gold, go back 100 years, it's 1-to-1 historically. Right now, the S&P 500 is basically 2.5 times. It was for a while 2.3 times the S&P 500. It's just gold's really cheap versus the S&P 500 is very expensive on that ratio. Um, and I use that because I can go back 100 years. I can put it on the same scale. The per ounce price of gold and S&P 500. History is 1-to-1. Right now, it's over 2-to-1. So it's not that complicated. That's one of the thing. Gold is as the stock market is just way expensive versus gold. Now, one thing I'm concerned about is gold's already rallied a lot. I mean, not as much as the stock market, but what I'm concerned about is it's going to meet in the middle at some point. They always have. Is it going to be different this time? And so I think also a proxy for gold is treasuries. Um, and that's unless we get a sharp inflationary environment. But the cycle is really working against that. You need some form of shock for inflation because the trend is towards deflation unless we debase the currency. And if we debase the currency, gold's some of the best ways to be. And I'll just point out the U.S. significantly debased the currency in 1933, FDR. But that was only after the stock market dropped about 90%. And we kind of had to. And that's what ended the deflation.
Mike, I've got a question for you. Following up on your discussion about that in particular, about the actual, Dow gold ratio, or not just Dow gold, but S&P gold ratio, and then how there's always the potential that they could devalue the dollar. What, in your view, do you think is the more likely course of action that's going to occur? Right? Is because you mentioned, the gold and the S&P will potentially meet somewhere in the middle. Do you think it will be more inflationary or more deflationary where they meet?
One bridge at a time. I just pulled it up on my screen to update. I went back to let's go 1900. The current ratio for the S&P 500 to gold is 2.2. Like I said, it's the same scale, and the historical average is 1.37. That's since 1927. One bridge at a time. The first bridge is you don't devalue the currency typically without a catalyst. And that's why I wanted to use that example. People say that's going to happen. They say, oh, there's only one way out of this debt to this massive excessive spending of, fiscal or monetary deficit spending of 6 to 7%. And it's that to debase the currency. It always takes a catalyst, and typically almost always in history means the stock market has to go down first. So one bridge at a time. And that's why I'm looking for just a little bit of normalization. I've been early. I've been wrong. But there's all the alternatives have been doing very well. I point out gold. I mean, if you're overweight in gold, you're keeping up with that AI-driven stock market. So one bridge at a time. I want to, we can hop on the show again. This might take years, but there's unlikely. I think the greater, and if you debase the currency versus what? Versus gold, sure, that's easy. But versus other fiat currencies, the U.S. dollar is unstoppable right now versus other fiat currencies because it's the best horse in the race, and everybody in the military gets that. Because of our military is part of it, and our high T-bill rates and our system. As much as we have discourse, that's what makes us great. But that's where I think people, when they say that's going to happen, and the Fed's going to just we're going to just flood the system, is you have to have that correction in risk assets first, and we haven't had that. Right now, there's no reason to change anything, and that's what's going to change because it's unstoppable right now.
It makes sense, yeah. You mentioned Bitcoin briefly too. Do you see Bitcoin at this stage as more of a safe haven like gold, or do you see it as more of a risk asset?
The latter. Clearly the latter. Now, I've been bullish Bitcoin most notably since 2019, and I really tempered that most notably this year. because it's been showing pretty significant divergent weakness versus gold, versus the stock market since making that perfect storm new high in March. I mean, it was on the back of the ETF's launch, the cut in supply. But I have to mention it because I think it's the number one 24/7 leading indicator. The launch of ETFs in this country was the biggest launch ever. I mean, there's so much inflows. I think the total inflows were, was it $15 billion, something like that? Total assets tracking in around 70. It's a great leading indicator, but its whole mantra was part of this rising tide of risk assets since it was first created in 2009. And that was when we really started quantitative easing and this money pump. We had the stock market's gone straight up. But now I think it's the opposite. And that's why I like to point out is when people tell you it's a risk off asset, I'm like, show me the proof. Basically, you have to remember volatility. Bitcoin is basically much more volatile than all other assets, most notably the stock market. It's about 3 times the volatility of the S&P 500. So when the S&P 500 goes down, virtually anything that has a higher volatility goes down more, unless it's designated by a technical or by a main reason to go up. So to me, that's the key risk. And that's why I'm looking at it. It's hovering around 65,000. Its peak this year was 73. It keeps dropping down with the stock market new highs. To me, that's showing the risk I'm afraid of in risk assets. I'm seeing it in commodities. Gold going up, commodities going down. I'm seeing it in data. I've seen declining demand for diesel, declining demand for unleaded gas, declining demand for corrugated boxes, increasing unemployment. And it's all tilting that way. So I look at it as, but in the big picture, macro, long term, I think gold investors need to have some Bitcoin in that space, but at some points you're supposed to overweight on a risk adjusted basis, and sometimes you're supposed to underweight. Right now it's an overweight gold situation, the way I see it, versus that digital asset. But it's for real. It's just, I view it as, bottom lines, it's a risk asset in a world of, well, risk assets are very elevated.
Well, Mike, I just have to say, I really appreciate the time that you've spent, describing a lot of these trends that you see, particular markets, a very unique perspective on this. And I know that our viewers have too. How, like, if our viewers want to follow your work or want to, follow you personally, what's the best way for them to do that?
So if I come back in your program, I'm on the Bloomberg terminal, and I do post on LinkedIn and X, and I'm happy to put people on my distribution list if they reach out. Typically, it's easier through LinkedIn, and it's Mike McGlone, Senior Commodity Strategist at Bloomberg, and on X, at Mike McGlone 11.
Great. I will put links below this video for that. Mike, again, thank you very much for joining us today, for sharing your wisdom. We'd love to have you back in the future.
Looking forward to it, Patrick. Thank you.
Yeah, and to the viewers, thanks for watching, and please remember to like and subscribe.